The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Hello there, and welcome to Talking Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. George, how are you doing? I hear you've been hanging with the cool kids at Tech Week.
Hey there, Ian. Lovely to chat. Ian, we bid adieu to London Tech Week again. It was me and a mere 30,000 people from 125 countries around the world. It just gets bigger. Probably slightly inappropriately named. It's not really Tech Week. This is People Week. And the big people stat of the week was that our Prime Minister wants to train up 7.5 million future programmers. The digital skills shortage, that's the biggest challenge to accelerated AI adoption. So PM is keen on training, but Keir's podium buddy is Jensen at NVIDIA. And in fairness to him, although he was quiet on the day, he believes that programming is no longer a vital skill in the AI age. Coding is going to be done by AI. And Jensen counsels us all that humans should focus on more valuable expertise like biology, education, manufacturing, or farming. So in fairness, there's still hope for me. And also concluded that the UK AI ecosystem is perfect for takeoff, just missing one thing, and that is having our own AI infrastructure.
Will he be selling one?
You would have to join the queue, but yes, he would have that. Also, in terms of the people narrative for the past week, we had the eagerly anticipated Q3 manpower employment survey. The big reveal on that one was the net employment outlook for Q3 is down a point to 24. We have more companies focusing on automation to handle repetitive tasks. We have 76% of employers expecting automation to bring the biggest changes to IT and data-focused roles over the next 5 years, and only 21% saying that automation has reduced the demand for some roles.
Who are these 21% where they think that automation has gone down?
They're the guys who read that far down in the survey. But at the same time, there is the whole pressure around the human in the loop. And that surfaced, I don't know if you saw, with an Apple report on LLMs saying that they're not there yet in terms of reasoning. Again, giving us data that we all felt we already knew. But what it is doing, particularly in terms of the agentic AI group, is really enabling them to find the place where humans and agents move. Back on to London Tech Week, for me, one of the most inspiring presentations was Adolfo, CEO at Capita, who suddenly sprang up in the middle of the Salesforce Agentforce live event.
What's their link exactly? What's he doing here?
You have a troublesome way of drilling straight into the facts here, Ian. Everyone is buying or selling at these things. And Capita is an Agentforce customer. And they were going through the use cases. Frankly, it was a compelling use case in terms of efficiency, but also in terms of customer experience. Now, Adolfo's shtick, if you will, is that he's very keen in terms of human in the loop. And the message there is that humans are better at complexity. They're better at scaling up problems. They're better at when there are issues around the underlying technology. It's better to sort of scale up to a human. So that's a positive for Capita FTEs, and a message I think that was very well made, given that they're there at the coalface, their customers being UK public sector and essential services. My other sort of favorite session was two of the leading lights at Xero in the early days. That was
Interesting.
Gary Turner and Steve Vamas. And that was an evening session from them in terms of telling the story of the success of Xero. But to sort of play to what you're really interested in, Steve has a new book. That's what they were selling.
Is it a page turner?
I find these things great page turners. Now, over the years, we've both met a number of CEOs who have written books. And for a lot of them, it's not just that you haven't turned the pages, but you're not sure if they have either. Xero, if you'll recall, was sort of founded in 2006, IPO'd in 2007 in Wellington, New Zealand, and they created a global company. So I find it fascinating in terms of the underlying learnings. Anyway, Ian, I'm conscious I'm sounding way too much like a fanboy. There's so much else. The week was packed. We also had the spending review.
Yes. My main sort of issue this week has been sort of scratching my head about the departures. The Alpha Wave, the Spectris, Ricardos. Alpha Wave we've spoken about before. It is going, and there's much gnashing of teeth on this one. But putting on the analyst hat or putting on the fund manager hat, I have to say that I'm not sure that anyone could have got this right in terms of investment decision, really, because it was coming in the last few months prior to the approach from Qualcomm, a little bit of a random punt, to be honest. How many people could have actually said to themselves, well, actually, I knew that there was an alpha wave shaped hole in the Qualcomm product portfolio. Given the scale of Qualcomm as a multi-$100 billion operation and the fact that we're only talking about a couple of billion here, really the idea that there was going to be anything coming from Qualcomm to say, look, we might be looking in this space, that was never going to happen. And Alpha Wave, as we know, had been approached by other parties in the last few months as well. So there was nothing to say, yeah, this is a dead cert. And frankly, on the sort of stock exchange issue, this was going to be a crazy one, no matter which stock exchange it ended up on, whether it ended up on NASDAQ, whether it ended up on LSE or wherever. With the backing it had in terms of Chinese links, yeah, it was never going to be a comfortable fit. And goodbye, God bless, never mind. The more interesting ones is Spectris. Ricardo is of some interest in that it's been around for years, but Spectris is the one that sort of floated my boat, really, because this was an interesting story when I was a fund manager many moons ago. It was an interesting story when I covered the electronics electricals sector, but it never really stuck out as being the great one, the best one, the highest value added. But it has, over the years, built itself up to be a pretty decent business. And you have to remember, this business has just been sold for $3.7 billion. So that's actually a credible business that has been built upon the UK stock market. The returns to investors from float, albeit in December 1988, is something like 4,700%. So London can do it with a tech-y company. But my one issue is obviously going to be the valuation and the way in which it was taken out at such a significant premium. Why does the UK market not see the value in these kinds of companies? And I think it goes back to what we discussed a couple of months back when I looked at Spectris, Renishaw and some others. These electronics electricals guys, they're just afraid to talk the techie talk. They're not seeing their products as something as part of the technology universe. They seem to want to talk about it as, we use this to produce that, rather than saying, hey, we've got something that measures this, and then with that data, somebody else can take this valuable data and do something even more valuable, or perhaps to risk bringing you in with edge computing, perhaps our devices can have some kind of power and agency themselves.
Ian, you're on very dodgy territory here. Are you saying the ability to tell a story is more important than the underlying facts of the business?
I think we have to say that there's a tendency in this country to look at the underlying facts as we see them this week, this month, and not to want to look beyond where is technology going, where is data collection, where are these instruments going? Because as we started the conversation about AI, okay, a lot of AI is not going in this direction at the moment quite yet, but we know that there is going to be greater intelligence built into systems, into manufacturing systems, into what people are doing. You go out and measure something with a Spectris instrument. Maybe this year it just takes in the data. Next year, maybe it starts doing something a bit more intelligent with it. Maybe the year after that, maybe it tells you to do something following that measurement because of what something else further off, connected via a 5G network, might be telling it to do. The UK messaging fund managers just seem to lack the vision or lack the context, perhaps.
If I can stand up for that constituency, they are by their nature long-term investors. And by long term, I don't mean they've constructed a DCF and they were just working at the cost of capital. They are long term, so they do want to know where is the company headed. Is your gripe that there's not enough due diligence in terms of the underlying long-term opportunities?
I think there's almost a sort of vicious circle in that the companies don't want to over-techie themselves.
Yeah.
So they don't start talking about, well, this is where some of the business can go. You don't have to tell the entire story about the entire business is going down some AI kind of route, but you do have to say, well, this is what some people could be using it for in a few years' time. It just seems to smack of a lack of imagination. And you have to think about it in the context of what are our competitors going to be thinking? And clearly, Advent are thinking there's a bit more to this than just monitoring stuff and measuring things.
Can I get you to roll back? You breezily talk through a number of the takeouts in the sector. Ricardo was a company that could tell a story. There was great clarity there. How do you do a compare and contrast in terms of Ricardo and Spectris, given that they've both ended up in the same place?
Yes, these were both nice companies to talk about. And Ricardo was the one that everybody loved. And actually, what's the return on 40 odd years of investment there? It's only 440 odd percent, not the 4,000 odd percent that you see with Spectris. Ricardo is a people business. You can't get away from it. And that's been sort of the problem, is that it's only gone so far. But I also say that and then have to think about where has it gone to? And this is back to the great British lack of imagination, perhaps. Where has it gone to? Well, it's gone to a company called WSP Global. Now, WSP Global, its roots are a company in Canada called Genivar. Genivar bought a company called WSP back in 2012. WSP was a British consulting, engineering, environmental services business. Since then, Genivar changed its name to WSP Global and has gone around the world buying up more and more business to now become a multi-billion dollar operation. It wasn't too long ago that it bought RPS for nearly £600 million. So it shows that from the kind of starting materials that we have in the UK, whether that be RPS, whether that Ricardo, or whether that be the original WSP, these businesses can be built. We could build global leaders. The question is, why don't we?
I feel compelled in the nature and spirit of sort of full disclosure to also comment that in terms of the yin and yang of the markets, GBG this week announced that it was commencing a move from AIM to the main market. But on the balancing positive, Global Data announced that ICG Europe was not going to proceed with the bid for Global Data. On that one, shares fell 12% in sympathy. How about corporate news this week, Ian? Have you seen anything there?
We've had a couple in. First one was iDocs, which, full disclosure, is a client of ours. Progressive, it just keeps on trucking. The UK public sector, local authority market, keeps demanding software, keeps moving over slowly but surely towards the cloud. It's not a race towards the cloud, and you can't force these customers to move towards the cloud, but that is what is happening. Geospatial is the exciting area of the business. Location data, anything to do with mapping where things are, how things interact. Yeah, that's going quite nicely, but there is a little bit of a problem in terms of the top line because there's been a sort of bunching of licensing over the year. So they typically do sort of 3 to 5 year deals. So you end up with license fee at the start and then run the support and maintenance over the rest of the period. So sometimes you can end up with a lot of licenses signed 1 year and very quiet the next. And that's what's happening this year. So overall order book, that was up 9%. So plenty to be happy about and satisfied with iDocs there. The other one that I found interesting was Molten Ventures. Annual results, nothing particularly surprising. It doesn't have the sort of dynamic news flow driven top line that everybody sees in corporate businesses as effectively a set of assets. I won't say an investment trust, but that is effectively what you're looking at, along with a little bit of a fund management business chucked in there as a value there as well. But this is effectively trading a 50% discount to the net asset value of the underlying assets.
Did you say 50%?
I say 50%, yeah.
Wow.
Yeah, and so for the maths challenge, that's 100% upside should it go back to the net asset value. Or maybe it won't go back up to that. Oh, it's fair enough to assume that it's not going to.
Have they been buying rubbish, Ian? Well, what's the story? That's quite a discount.
Why do people not believe it? Well, I think there are a number of what can be described as the grand technical issues, which are the general poor sentiment towards UK small cap.
Yeah.
UK small cap fund managers who might be the holders may have been withdrawing from there because they want to focus on their own management.
Can I be
of
really
their tech
cruel, Ian, and sort of roll you back and say, is this one of the companies that buys really interesting deep tech and nobody knows the story, the vision, the outlook?
No, this is A/B series. So it's not very early stage, it's post-seed. They are buying businesses. 40-50% of the businesses in the main portfolio will be profitable by the end of this year. Many of them already are, of course. But in terms of where are people perhaps seeing the risk, I think the fact that the portfolio is dominated by Revolut is going to be a key issue there.
Right.
Am I buying into Molten Ventures and a business or a portfolio that can do 20% year-on-year growth over the cycle, as it were, and as they have done? Or am I buying into, hey, some crazy valuation of Revolut? It's difficult to tell, difficult to get head inside the fund manager's mind, as it were. And it's a lot like you have 3i. They've got a big chunk in Action, which is this huge retailer across Europe, at the lower end, should we say, bigger valuation than Tesco.
Yeah.
It's not just tech companies that you can worry about the valuation of in these portfolios.
Sorry, that's all I do. But Ian, can I hopefully embarrass you? Did you get any sense, thinking about that discount, that people are also concerned that these assets, the exit is a little bit more difficult now, given the ongoing de-equitization in London? Or is that a factor at all?
Not for this business. Molten Ventures, it's not doing deep tech. It's not doing retail. It's not doing the stuff that you can sort of do a hypey float or do a conservative float out of. It's doing software technology businesses where the technology is proven. What we're talking about, is it going to get market traction? How long is it going to take? How big can it be?
Right.
Then typically Revolut, okay, maybe an exception. These are not businesses you say, good grief, that is going to take over the world. What you do is you look at them and thinking, oh, that business could be huge if it's in the right bigger organization. And that is what happens. Most of their sales are into trade. They're not into IPOs. So IPO is sort of, oh, if that happens, that'll be interesting set of circumstances. It's not, gosh, this is the track we're going down. No, most of their businesses, their investments are going to be going out trade. Maybe some of them are going to go out PE as well, but it's trade that is the eventual destination, because they are the guys who can see the big upside. They're the guys who can leverage these businesses.
And they will write the story themselves.
Exactly.
Remind us of one of your earlier points. Ian, we also had a company called GB Group this week. Now, we had a new CEO in there. We've got David Ward, the CFO. David, of course, earned his stripes at Aviva. They had an inline print this week. They reiterated guidance. Shares were smacked. Any views what the market is thinking along that one?
It's a bit of a confusing one for me.
Yes.
I can see that there's elements of nice bits of businesses all bundled together in different parts of the world, different things to get hyped about for different reasons.
Yes.
They're clearly getting to grips with it and creating a more coordinated, more 1GB group type business.
That's the GB Go product. Yes, gotcha.
Which all makes sort of what could be described as fund management sense. Whether that makes any bit of difference to the actual end customers, I'm not so sure.
And sadly, what we can't do is provide you with evidence because it's brand new.
Yes.
But you're right. It feels that this makes sense. This is a coherency. Yeah.
We don't know it makes sense until we've seen it done, as it were. I mean, it makes sense in fund manager land. That's what I worry about, not in customer land.
That's right. We don't have the evidence yet. Sadly, what we do have evidence is sequential growth declining through the year. That was one of the irksome points for the investment world.
But their focus is on other things, like getting the business to be a coordinated business. So
correct. At the same time, what I'm not getting from you is, wow, great story in here of deep embedded value. I'm not picking up that signal from you.
We don't have to have great story here, great embedded value. We have to have a reasonable business, good business that's going to get better as they get these things working. If they get these things working, that's an investment case. It doesn't have to be a world-beating, top-of-the-class global tech giant to be a decent tech business or a decent tech investment. Does it? Have I missed something?
So excuse me, where I thought you were going with that wasn't where you ended up. So to recover, businesses that can generate cash and create returns for shareholders are super businesses. The problem for both of us that maybe you just don't want to admit right now is that people are attracted to tech for growth. And when they don't do the growth things, that sort of creates all the problems. And yes, growth solves problems, and the absence of growth creates lots of other ones. But I'm a little bit distracted by this because when we're talking about they just need to be a good company. GB Group has an FCF margin of 18%. This is, I hate to say, a proper company generating cash, and that cash then can be used for, adventuring or buyback and dividends. So it is an interesting, well-developed, mature company. But I do take your point.
Well, I was about to contradict myself in my comments about the likes of Spectris about doing acquisitions. You've got to make some acquisitions to build a business. Realistically, a lot of these businesses you can't grow without doing acquisitions. And much as we'd love all these software companies to grow organically, realistically, they're not going to, because if you want to grow 7 or 8%, yeah, go ahead. You can keep chucking the cash back at the investors and be predictable, but no one's doing that. No one is actually going to give you a decent PE for that. Where you end up with that is you end up being part of a constellation, if you're lucky.
Right. You do raise the issue, though, around growth. And you said, 7-8%. You get a prize for that because the current year-to-date growth rate is 8.5% in terms of, Planet UK software. And I'm saying that simply to remind us both that the US peer group, because they've just closed in terms of reporting on Q1, we had Adobe, which sort of finishes off my list, but they're growing at 20%. And when we talk of sort of, is US exceptionalism, falling off a cliff? For me, you just look at that number and say, no, it isn't. They are flying along.
They're doing deals, though. This is part of the giant story that you don't see the deals being done almost.
They are doing deals, but that growth drug is absolutely there in strength. Now, they are guiding in terms of, Q2 as being 19%, but that's still, although slightly down on Q1, is still a magnificent number, and particularly so in the light of the UK numbers. I have some frustrations, companies could pull back in terms of the distributions that everyone is doing at the moment and channel some of it in to growth. And that could well be acquired growth. And, as we talk through the de-equitization story in terms of London, we could still say, hey, what about PLCs, buying other PLCs? Why doesn't someone do that? If these companies are cheap.
We are distinctly lacking in PLC on PLC activity here, it has to be said.
We are, absolutely, but that doesn't need to continue. At the same time, if everyone else is doing share buybacks, as we both know, every board will say, well, we must do share buybacks as well.
Or by somebody else. I mean, yes, it's quite bizarre how many are being bought by themselves.
That's right. And on that bombshell, the ongoing de-equitization of London, we should cheer our listener up.
How?
That wasn't a statement from me, Ian. That was a question.
It's summer.
It's summer. Have a superb weekend. And until the next one, thank you very much for your time and thoughts, Ian.
Good to talk to you, George. Cheers.
Brought to you by Progressive Equity.